Unpacking SIFs, a new investment playground for the masses. Welcome back, listeners, to another deep dive into the financial world where innovation and opportunity often collide. Today, we're peeling back the layers of a fresh development from India's markets regulator, the Securities Exchange Board of India, or SEBI. They've just rolled out a new category of investment vehicles called Specialized Investment Funds, or SIFs, and I'm excited to break down what this means for everyday investors like you and me. Picture this as a new playground for the mass affluent, those of us who aren't high net worth individuals but still want a taste of sophisticated investment strategies. Let's explore why SIFs might just be the game changer we've been waiting for, and why caution is still the name of the game. First, let's set the stage. SIFs are essentially managed funds designed to bring more flexibility to investment portfolios. Unlike traditional mutual funds that typically bet on stocks or bonds going up, SIFs allow fund managers to play both sides of the market. They can take short positions, meaning investors can profit even when prices of stocks, bonds, or other securities fall. Until now, this kind of strategy, think short selling or dabbling in unhedged derivatives, was mostly reserved for the ultra-wealthy through alternative investment funds, which required a minimum investment of a staggering 8 crore rupee or about $120,000. But SEBI has now lowered the barrier to entry with SIFs, setting the minimum investment at just 10 lakh rupee or roughly $12,000. This opens the door for a wider pool of investors to access tools that can potentially cushion their portfolios during market downturns. Now you might be wondering, what's the big deal with shorting or unhedged derivatives? Why does this matter? Well, imagine you're driving home late at night. You've got two routes. One is a straight, well-lit highway, and the other is a winding, unpredictable back road. If both get you home in the same time, you'd pick the safer route, right? That's the essence of what SIFs aim to deliver, risk-adjusted returns. They're not about chasing the highest possible gains at all costs. Instead, they focus on earning steady returns without exposing you to unnecessary volatility. In a traditional long-only portfolio, a market correction can hit hard. But with SIFs, fund managers can short sell up to 25% of the portfolio, meaning they can make money even when the market dips. In theory, this acts like a buffer, smoothing out the ride when things get bumpy. But here's where the story gets a bit more nuanced. SEBI has introduced 7 categories of SIFs, 3 focused on equity, 2 on debt, and 2 hybrid funds that mix both. Each category comes with its own investment mandate and risk profile. Just like regular mutual funds, equity-heavy SIFs will likely be more volatile than hybrid or debt-focused ones. And within each category, the specific strategy matters a lot. For instance, an equity SIF using a simple long-short strategy, balancing bets on rising and falling stocks, will carry a different risk than one focused on sector rotation, where the fund manager shifts investments between industries based on market trends. Then there's the fund manager's individual approach. One might allocate 80% to long positions and 25% to shorts, while another might dial back to 50% long and 25% short, with some cash on the sidelines. These decisions, along with the manager's knack for picking the right securities, will ultimately shape your returns. And let's not forget the human element in all this. Unlike long-only funds, where you might buy and hold indefinitely, SIFs require a bit more thought about when to enter and exit. Timing matters because the return curve in these portfolios isn't always intuitive. For the average investor, there's going to be a learning curve here. You might need to experiment a bit to figure out what aligns with your risk tolerance, and that trial and error process could come with some bumps along the way. So what's the endgame with SIFs? Are they about chasing incremental returns, or are they more about protecting your capital? The answer, as you might have guessed, is that it depends. Some SIF strategies will lean toward low-risk, arbitrage-like opportunities. Think of these as the safer bets on the lower end of the risk spectrum. Others might aim for absolute returns, trying to consistently outperform a basic benchmark index like the Nifty 50. Naturally, those come with higher risks. Each SIF is tied to its own curated benchmark, and comparing returns across categories like equity versus hybrid won't give you the full picture. Even within the same category, returns can vary widely based on how often the fund manager restructures the portfolio or how they position their bets. This brings us to a critical question. How do you as an individual investor pick the right SIF? How do you find a fund manager whose track record, security selection, and shorting skills match your goals? It's not as simple as just finding someone who's good with unhedged derivatives. SEBI has introduced a risk band for each SIF, similar to the risk-o-meter in regular mutual funds. A green line signals low risk, while a progression toward red warns of higher danger. But even with this visual guide, there's a catch. Pick the wrong strategy, and your returns could be the opposite of what you expected. It's a bit like choosing a dish off a menu. You might think you're ordering something mild, only to find out it's spicier than you can handle. There's also a structural perk to SIFs that's worth mentioning. Since they fall under the mutual fund umbrella, they come with the same tax efficiency as regular mutual funds, where taxes are often passed through to the investor in a favorable way. Structurally, SIFs are like the middle child of the investment world, not overlooked, but blending the flexibility of alternative funds with the accessibility of mutual funds. For retail investors, this combination is a key selling point. You're getting access to sophisticated strategies without needing the deep pockets of a high net worth individual. But let's end on a note of caution, because as exciting as SIFs sound, they're not a silver bullet. The promise of superior risk-adjusted returns is enticing, but the reality hinges on execution. The right strategy, the right fund manager, and the right timing all need to align. For the average investor, the learning curve is just beginning. You've got access to a powerful new tool, but wielding it effectively takes knowledge and patience. So tread carefully, do your homework, understand the strategy behind the SIF you're considering, and don't rush in expecting overnight miracles. That's all for today's episode, folks. SIFs are reshaping the investment landscape in India, democratizing access to strategies once reserved for the elite. But with great opportunity comes the need for great caution. I'd love to hear your thoughts. Are you intrigued by SIFs, or do you think the risks outweigh the rewards? Drop me a note and let's keep this conversation going. Until next time, stay curious and invest wisely.